People, please look at this. So before I look at my questions, I want to walk you through the main things that we look at under business finance and cost of capital. Right. Guys, business finance, what a fancy name. Yes, but it's very simple. How businesses get money to, operate, to invest in projects. That's what we are looking at under business finance. So business finance can be divided into two main areas, no? Right? Equity and debt. There you go. Yes, so companies, they get funding through equity, sometimes through debt, right? So you need to know the features of equity and debt, right? You need to know what types of funding options are there under equity, what types of funding options are there under debt, advantages, disadvantages, all that. Are we clear? So guys, I'm looking at the summary that is there in your study hub. Okay. Now, when we talk about business finance, right? Uh, Equity is the most important type of finance. Yes. You take a small businesses are majorly funded through equity, right? A small business owner may start his or her business with his or her money. That's equity, right? Okay. In FM, we don't talk about small businesses. We talk about big businesses which are listed in the stock exchange. Yes. So how do companies in the stock exchange raise capital or raise money via equity? People, they can issue ordinary shares. Yes. That's ordinary share capital. What else? What else? Ordinary share capital. They can also issue, preference shares, but preference shares are categorized under debt. Why is that? Because preference shares, we call them as hybrid financial instruments. So I'll highlight it. When you say equity, guys, yeah, mainly you're looking at ordinary share capital, and don't forget you have your retained earnings, right? Accumulated profits from previous years. There you go. Yes. Okay, so here you're looking at some relevant, relevant points under equity. So here, guys, you have getting a question. Hold on. What about irredeemable? Amra. Okay. Preference shares are considered as debt capital, right? I'm just looking at equity. Okay. So when you say equity, you're looking at mainly these two. Mainly these two. Right. Okay. So here, guys, you have some other relevant things like pecking order theory. I'm sure you talk about pecking order theory in class, right? Now, I'm not going to talk about theories today, not working capital, no, hell no. I'm not going to talk about methods of share issues like, you have subscription method, you have private placing, things like that are there. We don't talk about those today, right? I'm just looking at how businesses raise money. We know it's either using equity or debt, right? When you say equity capital, these are the two main types of equity capital, right? Sources of debt are, people, you have different types of debt. Yes. Simplest is the bank loan, right? You go to a bank, you borrow a loan, bank loan. You go for a lease agreement. That's a loan, essentially a loan. Sale and lease back, again a loan, right? But don't forget there are other loans like bond issues. Yes. deep discounted bonds, zero coupon bonds, mortgage loans. They are all debt financing, right? Or debt capital. Are we clear? Ah. So what are the main sources of debt capital? Main sources, guys, you're looking at preference shares, you're looking at bonds, you're looking at bank loans. These are short term. OD, bills of exchange, commercial papers, right? These are short term. And then you have small and medium enterprise debt financing, like, now, for small and medium scale enterprises, the government often provide what, like concessionary, interest rate loans, right? The government will say, look here, you borrow money from bank as a loan, will give you the loan at a lesser interest rate. There you go. They are called preferential loans. Yes. Ah. Um, and there are also people who are known as business angels. They provide money. They provide initial seed capital for entrepreneurs who don't have money, but they have a brilliant business idea. People, I'm sure you have watched shows on TV like, uh, guys, can you please refrain from drawing things on my screen? Please don't do that. I don't know how to change the bloody settings. Please don't do that, guys. Yeah, just don't write anything on the screen. I don't know how to, like, erase all this. Annotation. Please don't do that, guys. I don't know how to, like, erase all this. No idea. Right. Okay. What are we looking at? Sorry. Guys, because there are so many types of debt capital, we divide our debt capital into different headings, right? We divide debt capital into long-term debt, medium-term debt, short-term debt, right? Sometimes we divide debt capital based on the characteristics of the debt instrument. For example, you have convertible bonds. Yes. Guys, so what you need to understand is companies issue these instruments in the market to raise money so that they can invest that money in projects and whatnot. Are we clear? So because there are so many types of debt capital, let me say main types of debt capital. Right. What are the main types of debt capital? You have bond issues. Under bond issues, guys, these can be what? Redeemable bonds. Sometimes these can be irredeemable bonds. Then you have preference shares. Yes. Sometimes these are redeemable preference shares. Sometimes you have irredeemable preference shares. Yes, you have, don't forget, bond issues, preference shares, you have bank loans. Uh, these are like the main types of debt capital that you're looking at. Main. Are we clear? Are we clear? Does anyone has questions from this particular, area? I'm just looking at sources of debt, sources of equity. Are we clear? Clear, brilliant. Okay, now time to look at cost of capital. People, please understand that shareholders, they what? Shareholders, they invest money. invest money in businesses here. They invest money in businesses. They invest money. How? By buying shares. Yes, by buying shares. So it's actually a lending transaction. When they invest money, shareholders are lending money to the company, lending money to the company. Here you take my money, do something useful out of it. There you go. When they buy shares, they're simply lending money. People, when you lend money, you're not going to lend money for free. No, you're going to charge something, right? You're going to charge something. So shareholders in return, right? In return, what do? They demand returns for investing capital. Are we clear? No, I will be just giving you like a small refresher on cost of capital, and then straight away questions. For like 15 minutes, I'll be walking you through the things that you need to know. I'm not going to do theory today. Okay, right. So demand returns for investing capital. Yes. Uh, People, this is what cost of equity or return to equity. Yes. Shareholders, when they invest money in a business, right? It's simply a lending transaction. They're lending money to the company. So shareholders in return, they demand for what? In return, they demand for returns. In return for their capital, they want returns. That is cost of equity or return to equity. Guys, usually cost of equity, return to equity, they're the same thing. Sometimes known as KE, sometimes known as RE. They're the same thing. Are we clear? Are we clear, people? And it's usually a percentage, like 15%. There you go. Yes, right. People, this means for every $100 that is invested by shareholders, they want 115. Are we clear? Are we clear? Right. Okay. So same way, debt holders, right? Debt holders like what? Banks, bond investors. What do? They they lend money to the business. Yes, they lend money to the business, and just like before, debt holders what? They demand returns for investing capital. This is called cost of debt or return to debt. Guys, now here cost of equity and return to equity are the same. Here KD might not be necessarily equal to RD. This might not be the case, right? This is the case when there are no taxes. Now I'm sure you know what I'm talking about. Guys, when there are no taxes, KD and RD, they're the same. When there are taxes, right? Then cost of debt is KD into 1 minus T. There you go. When there are taxes, cost of debt is this. Return to debt is simply what? RD. There you go. No 1 minus T for return. Are we clear? People, I'm sure you know what I'm talking about. When there are taxes, cost of debt decreases. Yes. Why? Because tax savings, Modigliani and Miller. I hope that you can remember all these, right? Okay, so what you need to know under these two is how to calculate cost of equity and how to calculate cost of debt. Guys, cost of equity can be mainly calculated through what? Dividend valuation models or the CAPM model. Are we clear? Dividend valuation or CAPM. Right. Also, there is another method to calculate cost of equity. What is that? What is that, people? Modigliani and Miller. But I don't think you look at that equation in your syllabus, right? There is another method to calculate KE. That's Modigliani and Miller. You don't look at it in your syllabus. So you're looking at just these two, right? How do you calculate cost of debt? Cost of debt. My voice is breaking. Can you all hear me clearly? How about now? How about now? Okay. People, because there are so many debt instruments, right? You have different methods of calculating cost of debt. If it's an irredeemable debt, then this is how you calculate your KD. If it's just a bank loan, that is simple, right? If it's redeemable, if it's a bond, a redeemable bond, then you have to find the IRR, right? If it's a convertible debt, then again you have to find the IRR. Now, I'm not going to talk theory. Are we clear? So these are the things that you need to know. Now, a company can have both equity and debt. When you have both equity and debt, you have to calculate what? The WACC. WACC is weighted average cost of capital, right? So how do you find WACC? Simple, right? WACC is equal to, right? So you have value of equity, right? Divided by value of equity plus value of debt. Yes, I'm sure you know what I'm talking about. This into K. Yes, plus, yeah, same thing. I'll copy here. This is VD over VE plus VD, KD. Most of the time it's 1 minus T because you have taxes in your questions. There you go. This is how you find your WACC. Are we clear? Are we clear, everyone? Are we okay? Right. Good, good. Right. Brilliant. Okay. So guys, now under dividend valuation model, right? You have the dividend growth model, right? Growth model. You have dividend discount as well as dividend growth. So if there is growth, then you have to find the growth. There are two methods to find the growth, right? This is your Gordon's growth approximation. G is equal to RB, or you can use your past dividends to get the growth rate like this. So that is the current dividend divided by dividend in years ago to the power 1 over n minus 1. Are we clear? These are the things that you must know, people, before you sit for the exam. As in things that you have to know under what? Cost of capital. Are we clear? Right. Time to look at the question now. Hold on. Right. People, I have selected two questions. Two questions. I will share this on the group. Let's start with this one. Right. This is a solid question on cost of capital, guys. Hold on. Right. Okay. Solid question on cost of capital. Yes. Right. An old paper. Right. Okay. What do you do when you when you um, when you tackle section C questions? Firstly, guys, what do you do? Do you start reading the case study? No, hell no. What do? You look at the requirement. Yes, Ilma, you look at the requirement. Okay, let's see. By looking at the requirement, you can identify the area that is being tested. Okay, guys, now in your exam, so section C questions, you know that you have to answer them on the platform. Yes. So you need to show the working, right? You have to be very, very careful when you show the working because it has to look, it has to look clear. You can't like show the working here and there, get numbers. The presentation of the answer matters, right? Okay, what are we looking at here? Part A, calculate after tax weighted average cost of capital of TUFA on a market value basis. So we have to calculate the WACC, right? I just showed you how to calculate WACC. Are we clear? Right. Now let's do this. Let's not worry about these two. Let's do part A because part A carries 11 marks. This is what I want to focus on the most. Right. People, now in the exam, you have to read the question fast. But when I say fast, right, obviously you can't read the question, uh, you know, in a way that you what overlook the key data, right? So maybe highlight the key data, right, as you read, or I don't know, on your scratch paper, you note them down. I don't know, do something, or you note them down, in the Excel, the platform, ACCA platform, right? Okay, I will give you, right? I will give you 10 minutes to read. 10 minutes to read, people. Do it. All right, guys, I think that's enough time. There isn't much for you to read. So you're looking at a listed company too far. So your tax rate is 30%. Okay. So you have share capital, retained earnings, blah, blah, blah. Share capital of TOFA consists of $12 million of ordinary shares and 5 million irredeemable preference shares. Okay. So this 17 is made up of 12 and 5. 12 comes from ordinary shares, 5 comes from irredeemable preference shares. The ordinary shares of TUFA, nominal value is given 0.5. Ex-dividend market price 7.07. Cum dividend market price 7.52. People, ex-dividend is the price without the dividend. Cum dividend is the price with dividend, right? That's why the cum dividend price is higher, right? So if you want to get the dividend from the cum dividend price, you have to minus the ex-dividend price. Yes? Right. The dividend for 2007 will be paid in the near future. So see, the dividend is the difference between these two prices. Are we clear? Right. Dividend paid in recent years. Right. People, you're looking at number of years. Number of years, 2006 to 2003. People, I think I have to calculate a growth rate using these data. Okay. 5% preference shares have a nominal value of 0.5 per share. Okay. They tell you preference shares. 5% is the dividend. You know that preference shares have a fixed dividend, right? 5%. Nominal value, 0.5 per share. Ex-dividend market price is 0.31. Cool. Moving on. Long-term borrowing consists of 10 million loan notes and 3 million bank loan. So they're talking about long-term borrowings. This is made up of what? 10 million loan notes, 3 million bank loan. The bank loan has a variable interest rate, right? Okay. So variable interest rate. Cool. Moving on. The 7% loan notes have a nominal value of 100 per loan note and a market price of 102.34 per loan note. What? 7% loan note. So 7 is the interest rate. Nominal value 100. Market price 102.34. Annual interest has just been paid and loan notes are redeemable in 4 years at a 5% premium to nominal value. People, what are they talking about here? What is this paragraph? What are they talking about? Can someone tell me what instrument they are referring to in this paragraph? Anyone? Ilma? Kaif? Sachin? What is the instrument that they're referring to in this, in this paragraph? What is it? Very good. Redeemable debt. Solid. Yes, it's a bond, redeemable bond. Oh, no, Sunil. No, 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 no. How? No. If there is a convertible, if it's a convertible debt, then you have to have the conversion option. They have to talk about the conversion option. Here, nothing like that. Are we okay? No. Convertible loan is where your loan can be converted to shares. So this doesn't have that feature. Do you get it? So it's not a convertible debt, right? People, we have to calculate after tax weighted average cost of capital. Now, how many types of capital are there? My goodness, it's crazy. We have a hell of a lot of different types of capital. Firstly, we have share capital, ordinary. Then we have irredeemable preference shares, right? And then we have the bank loan, we have the bond, we have the the bond in the sense the loan notes and the bank loan, right? There are four things that we need to estimate, people. Are we clear? Right. So how do we do this? Let me firstly take the question to my Excel sheet. There's 1 second. Okay, right. Okay, there go people. Now we have to start doing our working. Now, where do we start? I mean, so many different types of capital, no? Right? Let's start with ordinary share capital, right? Ordinary share capital. So, because there are different types of capital, right? Different types of capital. So, we need to what? We need to show different working. Are we clear? You need to show different working. Make sure to number your workings, people. Right? We'll say working number one, uh, cost of ordinary shares, ordinary share capital. Right? People, obviously, I am going to have to use what? The dividend model, right? I'm going to have to use the dividend model. Yes, dividend valuation model. Right? You can say using dividend growth model. Growth model. So I know price per share according to dividend growth model is right. So D1, right? You divide D1 by what? K minus G. No? You divide D1 by K minus G, right? This is your equation. Are we clear? This is when you have growth, yes. When you have growth. Okay. What is the dividend? Dividend. Let's calculate D1. D1. Guys, they tell me the ex-dividend share price is 7. Cum dividend share price is 7.52. I know ex-dividend, now you may have learned this in class, ex-dividend price is cum dividend price minus dividend. Minus dividend payment. Yes. So I want the dividend payment. So let me take this to the other side and say dividend payment is equal to ex-dividend price minus cum dividend price. Right. Okay. Ex-dividend price is 7.52 minus cum dividend price is 7.52 is the cum and 7.07 is the um, uh, uh, ex-dividend price. So what's the difference? 7.52 minus 7.07. Right, there you go, people. This is my dividend payment. This is the dividend payment today. Don't forget that. Dividend payment today. This is D0, people, right? So I'm going to say this is current dividend. Current dividend. That is D0. Are we clear? Current dividend, D0. I want D1, man. I want D1. So how do I convert D0 to D1? D1 is D0. Don't forget 1 plus G, right? This is D1. This is D1. Okay, now I have to find the bloody growth rate. How do I do that? I know D0. I don't know G. Let's put a new working. G, growth rate. People, how are you going to find the growth rate? Obviously, this equation, the D0, that's current year dividend divided by D n years ago, right? Yes, right. So we'll get G using past dividend, right? So how do I get it? G is equal to D0. D0 is 0.45, no guys, yeah? D0 is 0.45 divided by what? Dividend n years ago. So you look at the oldest dividend, that is 0.37. There you go, right? Then what? You have to take this to the power 1 over n. Oh, damn. Wait, hold on. This is what I don't like about Excel, man. Ilma, are we okay? Kai, all good? All good up to now? Amruti, Devmini, Avisha, all good. Sachin, all good up to now? Right. Right. Okay, so what do I do? It's 1 over n, no? 1 over n, right? N is the number of years of growth, people. How do you get n? 2003 to 4, that's one. 4 to 5, that's another one. 5 to 6, that's another one. And then 6 to 7, that's another one. So altogether, how many years, people? Altogether, you're looking at 4 years, people. Altogether, you're looking at 4 years. Does that make sense? Does that make sense? So it's 1 over 4. 1 over 4 minus 1. There you go. Let me know if you don't understand how I got 4. Ilma, all okay up to now? Get me G. Yeah. Get me G, people. Give me the value. G is how much? G is 5%, right? G is 5%. Use your calculator. Get the answer. Done and done. Now let's say here 5%. That's my growth rate. Now I can find D1. Quickly find D1. D1 is therefore equal to D0. D0 is 0.45. 1 plus G. Always convert your percentages to decimals. Right? How much is this? How much is this, people? It's 0.4725, right? I'll take your answer, 0.4725. Done, done, and done. I found D1. Brilliant. So D1 is done, G is done. Now I can find K. I can find K, How do I find K? This is the equation, right? There you go. P0 is equal to D1 over K minus G. P0, people remember P0 is always your X dividend price. X dividend price. Always, it's the X dividend price. Right? So therefore, we'll get P0, right? So I want to make K the subject, right? So what do? D1 over P0 plus G, right? This is my K, right? Okay, so D1 over P0. How much is this? What's K, people? What's K? Give me K. 6.7. Huh? 6.7? Are you sure? 6.7? Ex-dividend price is 7.07. Now dividend is 0.47. How much is it? 4725 divided by P0. P0 is 7.07. This is my ex-dividend price. To this, you add the growth rate 0.05. What is KE? Anyone who didn't understand this working? Do we have to put the equations, formulas better? Better to put the equation, yes. Now, all these, some of these equations are actually there, right? The growth equation is there in your formula sheet. So no, I don't think that's necessary. You can simply say using dividend growth and, maybe, not have to show the equation. Yes, yes. This is 11.7. 11.7 is the answer. There you go. Done with cost of ordinary share capital. Are we clear? Are we clear, people? See, your working is very methodical. The examiner can understand what you have done. No big deal. Right. Now, working number two. Working number two. People, I remember the question talking about irredeemable preferentials. Irredeemable. Right. Let's say working number two, cost of oops. Working two, cost of irredeemable preference shares. Right. People, irredeemable in the sense perpetual, right? If something is perpetual, price is going to be, so price today is going to be the cash flow divided by the discounting rate, yes? So this is preference shares. So you need to divide the dividend by what? Dividend by cost of debt. There you go. Now, cost of irredeemable preference shares. So we are going to, categorize preference shares as, debt capital. So therefore, KD is what you need to calculate. Are we clear? Right. Okay, people, they give you P0. They give you P0 somewhere here. There you go. Price 5% preference shares, ex-dividend market price is 0.31. Now, so P0 is 0.31. P0 is 0.31. Right. D, do we know D? People, how do you find D? Dividend, fixed dividend, right? Fixed dividend. How do you find the nominal value into dividend percentage? This is how you find the dividend. Are we clear? This is how you find the dividend of preference shares. So therefore, let's get the nominal value. How much is it? 0.5. There you go. 0.5. Nominal value is 0.5. Dividend percentage, that is 5%, 0.05. 0.05. Right. So therefore, D is, how much is D? 0.025. Half into 0.05. Yeah, 0.025. There you go. This is the dividend. Okay. Now I can find KD, no? I can find KD, right? Okay. So therefore, you can say KD is equal to D divided by P0. Is how much? Okay, we'll plug the values in 0.025. You divide that by P0, 31. Right, there you go, people. It's 8.06. Done. 8.06. Are we clear? See, guys, now, now, even though you have different types of, capital here, calculating cost of capital is not Is not that difficult. Are we clear? Is everyone clear up to this? Five, are we okay? Five, all okay? Sachin, Isumi, the ones who are joining, all okay up to now? All okay, brilliant. Moving on. So we are done with what? Cost of ordinary shares. We are done with cost of preference shares. Done. Now let's do working number 3. People, working number 3. Let's talk about this long-term borrowing 10 million loan notes. No, let's talk about that. Right? Loan notes. This is the redeemable debt, people. Right? Redeemable debt. I'm going to just put the values in because there are so many things related to that, redeemable debt. Okay, what do they say? Right. Interest rate is how much? Interest rate or coupon, right? Interest rate or coupon is how much? 7%. Nominal value, NV, 100. Market value, how much? 102.34, right? Annual interest has just been paid, redeemable in 4 years. So T is 4 years, time to maturity, 4 years. What is this? Redeemable at 5% premium. Redeemable 5% premium, right? Okay. Okay, right. People, how do we find the cost of redeemable debt? How do we find the cost of redeemable debt? Let me show you. Cost of redeemable debt. Oh, no. Cost of base redeemable debt. There you go. Cost of redeemable debt. You have to find using IRR, right? You have to do a working, people. Are we clear? IRR, I hope you can remember, guys. IRR is what? Now, you may have your own way of remembering IRR. IRR is DCF low plus NPV high, right? NPV high, NPV high. What can I show this separately? NPV high, NPV high divided by NPV high minus NPV low. The whole thing into what? DCF high minus DCF low. Yes, DCF low. This is how you calculate IRR. Yes, right. Right. Sunil, no, this is how you calculate the IRR, right? NPV high divided by NPV high minus NPV low. Okay, right. Are we clear? Now, you may have your own interpretation, people. Like now, different tutors, different lecturers use different notations. This is the notation that I usually use, right? So, what do I need to do, people? I have to find IRR, right? To find IRR, I have to have two NPVs. Now, I have to calculate two NPVs. Are we clear? You need to calculate two NPVs. So, at what rates are we going to calculate the NPV? Any rate that you like, any rate. Yes, 5%, 10%, or 10%, 20%, any rate that you like. Can't we directly use? Yes, you can do that, but can you use IRR formula? Is this function available? I don't know whether it's available. Is it available? All right, okay, brilliant. Then you can find IRR using that. Super. Right. Okay. Cool. But then you need to show the cash flows. No, you need to show the cash flows, right? Okay, so this is what I'm going to do, right? um, People, to find the IRR, you have to show the cash flows. Yes, right. Now, what are the cash flows related to redeemable debt? What are the cash flows related to redeemable debt? Tell me, what are the cash flows? Cash flows related to redeemable debt. You have interest, and then what? Redemption valid, no? Interest and redemption valid. Very good. So I'll say cash flows of redeemable debt. Annual interest. Annual interest. How much is it, people? 7%, right? How do you find the annual interest? Again, nominal value into what? Coupon percentage. Coupon percentage. This is how you find the annual interest. Are we clear? Right? People, interest rate is my cost of debt. This is my KD, right? This is my cost of debt. Are we clear? But don't forget, in this question, you have what? Taxes. You have taxes, people. So therefore, annual interest is going to be nominal value um, uh, into coupon, right? Into 1 minus t, no? Into 1 minus t. Are we clear? Very good. Yes, are we clear, people? This is your annual interest. So let's get the annual interest. 100, 7% is my coupon. That into 1 minus t. Right. 7% into 1 minus t. Tax rate was 30% something. 30%, yeah, 0.3. Done. How much is this, people? Annual interest is 4.9 something. 4.9. Yes. Yes. Right. And you get the redemption value as well. Redemption value. What is your redemption value? They tell you redemption value is at 5% premium. Premium on what? Nominal value. So redemption value is nominal value plus the premium. This is your redemption value. Nominal value is 100. Premium 5% on the nominal value. So therefore, redemption value is 100. What is this? Yes. Okay. Now, people, what do I do? Now, what do I do? Now, let me show like a small table. Now, I know you can get the IRR straight away, but I think it's better to show the table, right? What table? Let me show you guys. TCF, right? DCF, let's take DCF at, I don't know, 5%. Yeah. Can you repeat the calculation again? What calculation? What calculation? So did you understand annual interest, Sunil? Annual interest is very simple, right? So nominal value into coupon percentage. Because there is tax, we have to take 1 minus t as well, right? Redemption value. Usually, guys, in your questions, there is, the redemption premium. So how do you find the redemption value? Nominal value plus the premium, right? Premium is calculated on the nominal value. They say 5%. So 5% on 100. Are we clear? Sunil, all good? Right. Okay. Now what do I do? I show the table. Show the table. TCF So here I can say CF into DCF, right? And then another DCF, let's say DCF at 10%. And then CF into DCF, right? You start from T0. Don't forget T0. You start from T0. Yes, done. Right. Okay. T0, T0, you always put what? The cost of the bond or the market value, 102.34. Yes, 102.34. People, discounting factor at 5%, at 10%, at 100%, whatever. For T0, it's always 1. So multiply the cash flow by the discounting factor to get the PV. Right now. Don't forget this is a negative value because you're paying money. Here also it's 1 multiply cash flow by the discounting factor. Right now, plug in the other values. 1, 2, 3, 4, right? So in the years leading up to maturity, you get the annual interest how much? 4.9. 4.9, 4.9, 4.9, 4.9. In addition to 4.9 in year 4, that is the redemption year, you get the redemption premium as well, 105. Are we clear? Now you can look up the discounting factors. You can look up the discounting factors and quickly plug in the values. Yes. Quickly plug in the value. So you can even use annuity factors, but I don't really recommend it because sometimes you get confused. Just 4 years, use your normal discounting factors to get the answer, right? Okay. Right. What are your discounting factors? 1 divided by 1.05, 0.952. 1 divided by 1.05 to the power of 2, 0.907. 1 divided by 1.05 to the power of 3, 0.864. Last one. 1 divided by 1.05 to the power of 4. 0.823. Right. Multiply the cash flow by the discounted factor. There you go. So what is your NPV at O? So this is, can I say 109.9? Because 104, 105 plus 105 plus 4.9 is 109. 109.9, there you go. Add these up, you get your NPV. This is your NPV. NPV at 5%. There you go. At 10%, 0.909, 0.826, 0.751, and 0.683. 751 divided by 1.1. 683. Now what do I do? Multiply the cash flow by the discounting factor. Get the NPV. Done. There you go. You have the NPVs. Now what? Now you get the IRR. Now you get the IRR. What's your IRR, guys? I'm trying to write. 5%. Is IRR 5%? 5.39 something, no? 5.39 something. Okay, right. IRR 5.4%. Yep, done. So IRR is my cost of debt or cost of redeemable debt here, people. Yes, so let's put a small working somewhere here. Working number 3, no? Working 3. Cost of redeemable debt. Right. People, are we done? Are we done? Guys, now they're talking about, 3 million bank loan, right? Um, the bank loan has a variable interest rate. So what do we do about that? Variable interest rate is not given. Variable interest rate is not given. What do we do? What do we do? Interest rate is not given. Now we have to make an assumption, people. Now the loan is not definitely free of charge, right? This 3 million that they're talking about, variable interest rate. Now what do? We have to make an assumption. What is assumption? Right? So let's say working number 4, cost of bank loan. Cost of bank loan. Right. Working number 4. What do I do? What do I do? I can say this is a variable interest rate loan. Interest rate is not stated. Therefore, assuming that interest rate is, what is interest rate that we need to assume, people? Interest rate, how much should it be? How much should it be? You have to make an assumption because it's not stated, no? Guys, now the closest to the bank loan in this case, the closest instrument to the bank loan in this case is my bond, redeemable in 4 years, right? Redeemable in 4 years. So the bond has an interest rate of 5.4. So I think we have to go with that 5.4. Yeah, 4. Yeah, in between. So you can make an assumption, right? Even if you take it as 5%, it's completely fine as long as you state it. Assume that interest rate is 5.4%. In brackets, I'll say as the cost of redeemable debt. Cost of redeemable debt is also the redeemable debt is also 5.4%. Are we clear, people? Yeah. Yes, of course. Debt is cheaper. That's what. No, now even bonds are cheaper. Bond is a debt, no, right? So we say cost of debt is cheaper compared to cost of equity, right? We can't assume that cost of debt is 12%, right? Cost of equity, right? Ordinary shares return is the highest. Then preference shares, you can clearly see that it's 8%. Then your your redeemable debt, right? You know, Definitely it has to be cheaper. Cost of debt as a whole is cheaper. That's what you need to understand, so right? We can make another assumption. Yeah, so you can say assuming cost of debt is 5%, right? Because now actually here the loan is 10 million, right? Guys, look at this, will you? Long-term borrowing, this loan is what do you call, the bond is 10 million. Higher the loan value, higher the interest rate, no? So here it's just the 3 million loan. So you can assume, bank loan rate is like 5%. And say, the loan rate, bond rate is 5.4, but that is for 10 million. The bank loan is only 3 million. So the interest rate must be lower. Some assumption, that makes sense. Anything is all right, people, as long as you make the assumption, but you can't come up with like ridiculous assumptions, huh? Right? You can't write bylaw and say, okay, this is 6% because of that, because of this. No, your assumption has to be reasonable. Okay, so this is a reasonable assumption, even if you assume, right? So I'll write this in a different color. Interest rate is assumed to be 5%. Why 5%? Assumed to be 5%. Why? Because the redeemable loan note is 10 million and the cost is 5.4%. The bank loan is only for 3 million. Therefore, cost should be less. Something like that. As long as you make a reasonable assumption, no problem at all. Are we clear? Are we clear? Done. So we have found the cost of all our capital instruments. Right. Now what do we do? Now WACC. People, how do I calculate WACC? WACC, they tell me WACC should be based on what? Market value. Should be based on market value, no? So therefore, what do I do? So it has to be market value of equity, right? Actually, I wrote the WACC equation before, right? Let me copy that. Oh. People, you have number of instruments. That's the problem. You have how much? Oh my goodness. Wait. You have number of instruments. No. You know what? Let's show it like this. So you understand that WACC is the weighted average of the values of equity and values of debt adjusted for their respective costs, right? Okay. Now, I don't know, let's say ordinary share capital. Ordinary share capital. Are we clear? Ordinary share capital. People, now we have to find the market value. We have to find the market value, right? Can I say market value here up on top? Market price, I know ex-dividend price is 7.07, right? How many shares do you have? How many shares do you have? How many shares? 12 million. Nominal value is 0.5. 0.5. How many shares do you have, people? 24,000, no? 24,000. 24,000 million, actually. No, 24 million. How do I get this 24 million, people? You know what? I think I have to show the in detail breakdown. Can we say nominal value? Nominal value. Nominal value units issued, units issued, unit price, total market value, total market value, right? Okay. People nominal value per share, they tell me it's how much? 0.5, 0.5, right? Units issued, unit price. People, they tell me total nominal value is 12 million. Share capital is 12 million. This is your balance sheet. So in the balance sheet, everything is recorded at historical cost. So here, what you're looking at is basically the book value of shares. Book value is basically the nominal value. So 12 million is the value. One share is 0.5. So 12 million divided by 0.5, right? 12 million divided by 0.5, that's 24 million. 24 million. Does that make sense? Right? 24 million. Right. Price of a share is unit price. Home dividend price 7.07. No? So total market value. My goodness. Oh, one massive value. My goodness. Right. That's okay. That's fine. Right. Okay. Ordinary share capital. Now preference share capital. Preference shares. Preference shares, guys, they tell you your nominal value is again 0.5. There you go, 0.5. 0.5. How many shares? Preference share capital is $5 million. So 0.5 divided by 0.5 divided by what? 5, no? So 0.5 divided by 5, 0.5 million. Sorry, 5 million divided by 0.5. My bad, people. You're looking at 10 million shares, no? 10 million shares. What is the market price? 0.31 something. 0.31, right? Give the market value. Done. Guys, are you following this? Is everyone okay? Because you have number of different types of capital, right? Let's not show the answer in this way. This is just time consuming, man. Okay, right? Okay, preference shares. Now let's talk about what? Let's talk about redeemable bonds. Redeemable bonds. People, redeemable bonds. Let's go and have a look. Nominal value of redeemable bond. There you go. 100. They have 10 million loan notes. 10 million. So 10 million divided by 100. No, that is going to give me the number of units. So this is 100. This is 10 million. 10 million divided by 100. Oops. 10 million divided by 100. This many bonds are in issue. There. 100,000. What's the unit price? They gave me the price of the bond. Yes, 102 point something. 102.34. Right. Get this. Last one, bank loan. Bank loan. They give me the value straight away. Now bank loans are not marketable. Guys, you know that bank loans are not marketable unless you're talking about something like securitization. Bank loans are not marketable. So the market value of the bank loan is still 3 million. Does that make sense? So just put 3 million here. Are we clear? Now, this is your total capital. Total capital. Ah. Now you can get the percentage, the weight. Let's get the weight. How do I get the weight? Divide each by the total capital, multiply by 100. Ah. Go. Did I make a mistake or what? This divided by this divided by this. Right. These are the weights, people. Now what do? Multiply the weight by the cost. Cost of equity debt. Equity or debt. So this was 11 point something. Cost of equity. What was it, guys? Cost of equity 11.7, 8.06, 11.7, 8.06. People, I always prefer to work with decimals. I prefer to work with decimals, so that's why I don't put percentages. Cost of debt 0.054, 0.054. Now multiply each by weight into cost. Multiply this by this. Add these up, that's your back. Right. People, what did I do here? I got the weight. What is the weight? That's this. Whatever the capital type divided by the total capital. That is the weight. So what did I do? This divided by this. What did I do here? This divided by this. Are we clear, people? And then multiply the weight by cost of equity or cost of debt. There you go. People, does this make sense? Correct only. What's that? Understood. Is everyone okay with this? Germany, okay. Ashfa, Amruti, Abhisha, Sachin, all good. Sumi, all good. Yes, right. Good. All good. Okay. People, now I'm sure you can, do something for a question like this in the exam. Make sure to show your answers in a methodical manner. Number your workings, right? Number them. Working number 1. Okay. Working number 2. There you go. Examiner will look for your working, right? Examiner will look for the source of your answers. So make it easy for him to locate those sources. If your answers are here and there, your examiner is not going to like it. He's going to look at it anyhow, but he's not going to like it that much. Are we clear, people? Are we clear? Are we clear? Right. Still not done with the question. No, still not done. Right. Let's see. Let's see what they talk about here. What do they talk about? Discuss the circumstances under which it is appropriate to use the current WACC of too far in appraising an investment project. People, this is a good question. How do you answer this? In what kind of situations can you use this current WACC? What is the WACC? WACC is, there you go, this is the WACC. Yep, this is your WACC. In 200, 11.19. In what kind of situations can we use this WACC? People, when there are many sources of debt, no, not the case, Ajay. Please look at the question. In what kind of situations can you use this current WACC in appraising an investment project? Now, I am sure your tutor may have looked at the impact on WACC if the risk is changing, right? People, I'm talking about re-gearing, de-gearing, in other words, right? Sometimes you have to re-gear, sometimes you have to de-gear. Can you remember? Yes. Let's say, simple example. Part B, I'm trying to explain part B. Part B is theory. Part B is theory, right? Example, okay? Let's say there is a company, simple company. They have debt to equity ratio, let's say debt is 40% and equity is 60%, right? Equity is 60%. Are we clear? Debt is 40, equity is 60, right? Okay. Let's say they have beta, they have WACC of, let's say, 50%. This is the WACC right now. Okay. There is a new project. Risk of project is the same as existing risks. Existing business risks. Right. Now, the new project is entirely financed with, let's say, with retained earnings. You have what? Profits from previous years, right? You're using that money to fund the project, right? Let's say your cash flows of the project, right? 1, 2, 3, 4. I'm just taking a random, more simple example. 100, 200, 300, 400. These are, let's say, your net cash flows. Now, you have to discount the net cash flows. At what rate do you discount? Tell me, at what rate do you discount? Yeah. At what rate? Exactly, WACC. You discount at the WACC. WACC is 15%. Yes. So we discount this by 1 over 1.1, 1 over 1.15 to the power 1. Here 1 over 1.15 to the power 2. Like that, yes. So here I can use the current WACC to discount the cash flows of the new project. That's what I'm doing. This is my new project. These are the cash flows. I'm discounting the cash flows using existing WACC diagram. Existing WACC. Why can I use the existing WACC here? Because the risk of the project is the same as the risk of the business. Risks are not changing. In other words, people, that risk and the WACC have a major relationship. Higher the risk, higher the WACC, right? Higher the risk, higher the WACC. Higher the risk, higher the return. In other words, if the risks are not changing, then you can use the existing WACC. Are we clear? If you are financing your project with your retained earnings, right, then your WACC is not going to change. So I have looked at two things at the same time. So 3 marks, no? 3 marks, right? 3 marks. Discuss, people, discuss. So, your answer can't be a one-line explanation, right? It has to be a brief explanation. Does that make sense? Does that make sense, people? If the existing business risk is not changing, if the risk of the project and the risk of the company are the same, then you can use the existing WACC, right? So let me say existing WACC can be used to discount the cash flows of a new project if 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 should the financial risk. Yes, that's why I said, now I will look at financial risk later, right? So here, do you see that my existing risks and my, financial risks? So this is my business risk. Business risk is my operational risk, right? Because I'm funding this with my retained earnings. So financial risk is also the same, right? So now I need to say if the business risks of the project and the company are the same, and project is financed with retained earnings, retained earnings, then no, existing that can be used. There you go. Number one. This is number one. Right. Now imagine something like this, people. Right? I'm going to make a small change. Risk of the project and the business risks, they're the same. But let's say the new project requires you to borrow money, right? New project is funded through what? Through debt. The new project is funded through debt. Now, because you're undertaking debt, your capital structure is going to change, right? After debt undertaking, right? Your gearing after debt undertaking, gearing. Let's say new gearing is debt is 45%, equity is 55%. Now what has happened? Operational risks are the same, but financial risk is now different. Financial risk is different. Operational risk, same. Financial risk, different. Why is that? Because of your project, your capital structure is changing. So therefore, WACC can't be 15%. WACC is going to increase. Are we clear? Are we clear? If the business risk of the project and the company and the project is financed with retained earnings, then no problem. Nothing is going to change. Right? Nothing is going to change. Then you can use the existing WACC. You tell me another scenario, people. Now I've shown you if your capital structure is changing, that means financial risk is changing. That means WACC is also changing. So you can't use the existing WACC to discount the cash flows. Are we clear? Yes. What are the other situations? You tell me, people. What are the other situations? Other situations? Guys, what about new project is funded through equity? What if the new project is funded through equity? So after you issue equity, equity issue, what's going to happen? Debt is going to go down 35%, equity is going to go up 65%. Very good. No finance risk, no. So here, guys, you're going to get finance risk as you undertake more and more debt. That's the logic, right? As you undertake more and more debt, that's when your finance risk is going to change. Does that make sense? Does that make sense? Is that clear? If your debt is increasing, right, then your financial risks are going to increase. So therefore, WACC is going to change. Equity, not the case. Is that clear, people? Is that clear? Is that clear? If the business risks of the project and the company are the same, and project is financed with equity. Very good. With equity. Then also you can use the existing WACC. Are we clear? I think this is enough. People, when you write an answer like this, the examiner will know that you know your shit, that you have studied, in other words. Someone who has not studied will never be able to come up with an answer like this. Are we clear? So here, guys, to impress the examiner, you can say in both scenarios above, business risk and financial risks remain the same. Financial risk remain the same. So when we fund through equity, then there is no change in operational risk. Amurti, is your, like, now for example, let's say your company is into automobile. This is the industry that you're operating. Let's say new project is, let's say, I don't know, FMCG. So now operational risks are different. Operational risks are basically risks attached to the industry that you're into. You get it? Operational risks are different. In both scenarios, your operational risks remain the same. If your operational risks are not the same, then WACC has to change, no? Does that make sense, Amuti? Does that make sense? Think about it. Right now, you're operating in the automobile market, right? You're thinking of, implementing a project that is related to FMCG. Now you're going to have a completely different, business, which is going to have completely different risks. Does that make sense? Does that make sense? Yeah. Okay. Are we clear, people? I think this is enough. This is enough for 3 months. This is to impress the examiner people. You tell them that in both scenarios, what? Your business risks and financial risks, they remain the same. Are we clear? Are we clear? Guys, right. Guys, I'm thinking, right? Thinking about something. So here, if the project is funded through new equity, the project is funded through new equity, I mean, there is no looking at the WACC equation. Yes, I'm thinking about WACC, the mathematical impact on it. What's going to happen to WACC? About it, if I issue new equity, then V is going to increase now. This is going to increase, right? So therefore, this component is going to change, no? If you issue equity, can we adjust this statement like this? If the business risk of the project and company are the same, and project is financed in a way that in a way that that does not impact the capital structure capital structure of the business. Can I put it like that, guys? Now, when you think about the mathematical impact, I'm thinking about mathematical impact. So earlier, right? So WACC is based on equity 60%, debt 40%, right? Now, after project, this is before. This is before. After WACC is, so equity is 65%, debt is 35%. What do you think? Thinking about the mathematical impact. What do you think, people? In a way that mirrors the capital structure. Guys, definitely your WACC is going to change if you issue just equity, right? To finance the equity. You know why? Because mathematical impact, think about it. Now here you have 65, here you have 35. Earlier it's 60 and 40. WACC is going to change now. Does that make sense, people? Guys, I'm going to retract what I said before. If you issue just equity, right? Your share of equity in the capital structure is going to increase. So WACC is going to take a hit. WACC is going to change for sure. Think about the mathematical impact. Sachin, do you see that? Mathematical impact is definitely there, right? Okay. So, guys, let me come up with a new point. So, please make sure that you change the second answer point in this way. Business risk of the project and the company are the same, and project is financed in a way project is financed in a way that does not impact the capital structure of the business, right? Imagine something like this, yeah, right? Imagine something like this. Before project, right? I'll say before project back is 60/40, right? Let's say for the project, imagine something like this, yeah? Project, right? Project cost is, let's say, 100,000, right? Where you decide, right? Now, cost of the project is 100,000. You decide to borrow as well as issue shares. You issue shares amounting to 60%. This is E, right? And you borrow amounting to 40%. People, do you see that this project is basically copying my existing capital structure? Do you see that? The project is copying the existing capital structure. No change. In that case also, your VAT can be used. Existing VAT can be used. Does that make sense? So I'm going to say if the project has the same share of debt and equity as the company's capital structure, then also you can use your existing VAT. People, does that make sense? Sachin, are we clear? Right? Are we clear, people? All good? Right. I think that's enough. That's enough on this question, man. Right. Part C. Let's look at part C. Oh, this is simple. Discuss 3 advantages. 3 advantages of using convertible loan notes. People, the biggest advantage of using convertible loan notes is what? The biggest advantage? What's the biggest advantage? Biggest advantage is you're borrowing money, but this is a convertible debt. Because it's convertible, no need to repay. Oh no, Sachin, you still have to pay the interest on it. What if the convertible debt holder decides not to, exercise? Then you still have to pay. No, that's not an advantage. What is the biggest advantage? Guys, the biggest advantage, right? The biggest, what is this? The biggest advantage of issuing convertible debt is your interest rate on convertible debt is lower than other types of debt. Interest rate is less. Why is that? Because your debt has a special feature. You can convert the debt into equity. This is the biggest advantage. Are we clear? Okay. Biggest advantage. Does that make sense? This is the biggest advantage, people. Right? So, Sachin, you could actually, say that no need to, the company may not need to have lot of money at the maturity to settle the debt if the debt holder decides to what? Decides to exercise the option. Can we put it like that? Let's put this in this way, yeah? Are we clear? Yeah, right. Okay. Guys, for 6 marks, you need to explain these. Yeah, you need to explain these. Now, at least another point. People now, for every company, there is this, there is this concept called debt capacity. What is debt capacity? Capacity is the limit, nomen limit, right? Every company has a debt capacity, like a maximum limit to which that they can borrow, right? Now, when you go for convertible debt, right? Because you have the convertible option, if the debt holder exercises the option, then what? Automatically, your debt capacity is going to improve, right? I'm going to say convertible debt if, sorry, say if debt holders convert debt into equity, then the company benefits from improved debt capacity at zero cost. At zero cost. Guys, now you borrow a loan, let's say 5,000, borrow a loan, how much? 5,000, right? Because of this loan, your debt capacity decreases by, due to the loan, debt capacity reduces by 5,000. How do you increase it? How do you improve it? You have to settle the debt, no man. To settle the, sorry, to improve debt capacity. To improve debt capacity, you have to settle the debt. Now, to settle the debt, you have to have money. But in convertible debt, people, if the debt holder converts debt into equity, then at zero cost, your debt capacity is increasing. That's a major benefit. Is that clear? Is that clear, people? Is that clear? Are we clear on this, people? Amra, Amulti, Ashfa, are we clear? Only 8 people are remaining in the class, right? All good, clear? Good, 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 brilliant. Now, guys, please understand all your questions on cost of capital are, like this only, right? So they give you a scenario, you have a lot of things, right? Start from something that you are familiar with. For example, I started with cost of equity because I'm familiar with that. It's easy. Any idiot can do a cost of equity calculation, right? The bond calculation, if you don't know this 1 minus, if you don't put this 1 minus t, you end up with a different interest. So your cost of debt is going to change, right? So I would say this is the most, like, difficult working in the question, but even this is a joke, right? But if you make a mistake, this is where you're going to, this is where you're going to make that mistake. People, are we clear? So this is a solid question on cost of capital, a solid one. Yes. But there are so many other equations related to cost of capital that was not discussed in this question, right? For example, CAPM was not tested, right? You didn't have convertible debts. You didn't have Gordon's growth approximation. We use this. So guys, my advice is, right, attempt as much as possible questions on your own. If you get stuck, that's completely fine. Look at the examiner's answer, right? Get exposed to as many as possible questions so that on the exam day, there are no surprises, right? Guys, now I don't want to extend the class any longer because it's 9:20 already. We started the class late. I was planning to look at two questions, but obviously, as you can see, because of the revision that I did, maybe, don't have the time, time went by. So what you can do is you can, what's the approach for theory? Study approach for theory. Theory, now, okay, so these, actually, Sunil, in FM, please expect more theory questions than numerical ones. You know why? Everyone focuses on the numbers part extensively, right? Now, this is a very old paper, right? 17. You, Adi, look at this, will you? 9 marks from theory, no? 1 second, please. So out of 20, 9 marks are, straight from theory. So how do you study theory? I mean, it's not like you can, sit down, put your feet in a bucket of water and start reading all these narrative areas that is coming under all these chapters. No, that's crazy. You'll go nuts. So what you can do is, right, now, the major areas that are tested in everything: cost of capital, capital structures, investment appraisal, dividend policy, frequently tested. Yes. So when you practice questions on those, specifically focus on the theory part. Now, usually what happens is students spend way too much time on the calculation. And, after this, they're tired. And this is just theory. Screw it. You close the laptop, you go do something else. This is what happens most of the time, people. In some of these questions, guys, theory questions, to answer the theory questions, you don't need to know the case study in full. You can just, write something. So my advice, when you have the time, when you're like fresh, maybe look at, a few questions, let's say on cost of capital. Look at the theory parts in each of those questions. Let's say you look at, 2018 paper, 2019 paper, 2020. Now, in most of these papers, you have a question on cost of capital, right? Look at the theory parts, see whether you can answer them. That's one way of like approaching theory, right? That's what I would do. I can't read just theory. And, even if you read, it's not like you understand everything. There is a higher chance of you understanding theory when you look at theory with a question, right? So why don't you try that, Sunil? In FM, do get, oh, no, no, no. They don't get repeated, as in like, you don't get the same question, but I mean, you see some level of repetition. For example, investment appraisal. In investment appraisal, yeah, you have, what do you call, you have working capital, you have inflation, you have all those adjustments, capital allowances. Ah, so what you can do is, Sunil, now you can do your own analysis by looking at the revision kit that you have from Kaplan. Look at the analysis, right? Understand the areas which have been tested like most frequently, right? And then also please look at the questions in the study hub, because in your Kaplan, revision kit or BPP, you don't have questions from very recent papers, right? Very recent ones. For example, last year, you may not have questions from, the last semester, the exams in December in your Kaplan revision kit. Go to the study hub, your exam platform, do some questions. Yes, the questions do get repeated, but it's not, you know, well, the logic will be the same. Now, investment appraisal. Now, there's another question in my handout, right? Let me show that to you. Now, here, see, you have the same setting, coffee, right? Here, guys, they talk about risk-free return, equity risk premium, equity beta. So this is definitely capital, right? Calculate WACC. There you go. Same thing, no? Same thing, right? Compulsory 20 mark questions for investment appraisal, business finance, working capital. Those are your like sure and short compulsory 20 mark questions, right? Why don't you go through, Sunil? Have you gone through your revision kit? Have you gone through your like revision kit? You need to, if you have not, please go through the revision kit. Yeah, I know. Three sections. No. So please look at the analysis. They have an analysis, no, right? In the first few pages in the revision kit, they do the analysis, right? Maybe look at the analysis, then you can identify, for yourself, right? I will also do an analysis, and I will give you like an idea. I thought one would be compulsory. No, 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 no. Now, in FM, because you're looking at like a vast, you know, different types of areas, you can get questions on even ratios. You can get questions on valuations, cost of capital, investment appraisal, working capital. Oh my goodness, there are so many areas. So yeah, better to look at least 2 to 3 questions from each of those areas. Okay, you still have time, right? You still have time. No need to panic. You have plenty of time. Maybe, yeah, before anything, you need to understand the mind of the examiner. Right now, you can't predict everything, but you can predict to a certain extent. You're not a complete, donkey, right? You can look at the papers and get an idea. Okay, investment appraisal has been tested in 4 years out of 6 years. There you go. Like that, you can, get an idea. No? My advice, you do that on your own. It's going to take some time, people. Understand the most like popular areas of the exam. Now, in revision, what I do is those like, popular areas. Questions from the popular areas. Are we clear? Are we clear, Pete? Please do that on your own. I will also do an analysis, right? And I'll brief you on it maybe in the next class. Are we okay? Right? Okay. Good questions. Good questions. Right. Okay. Right. No problem, Sachin. I'm sorry, guys. I have to finish the class. I usually do 2 questions. Now, maybe what I can do is I can ask you to like go through. No, it's better to do the question with me in class, right? Because in the exam also you're going to have to, you're going to have to answer like unseen questions, no, right? So you have to have that element of surprise, like anyway, people, you can do this question on your own coffee company. This is from a reason paper, right? Now, obviously, guys, I don't have the time to look at all the questions. Maybe look at one or two questions from the reason papers to see how cost of capital is tested, right? Just go through the question, see whether you understand what they tell you. If it's like unfamiliar, then maybe attempt it. You don't have the time to attempt everything. Yes, of course, Ashfa. I'll share this on the WhatsApp group. People, I've been talking nonstop for the past 2 hours, man. Okay. I hope you got something out of this session, though, people, right? Uh, I will do an analysis. I also need to do an analysis. To be really honest, guys, now I did not do like an in detail analysis on the recent papers to identify which areas have been like tested. But your examiner, please don't don't do what do you call spot. You don't do question spotting people, right? You need to be ready for everything. Okay, so let me see, guys. I should be able to do like a small analysis and let you all know on that. Let's do more questions next week, right? We'll try to answer at least two. Okay. All right, people. When's the next class, Sunil? Yes, Skype. Thank you. Good night. Next class will be on next Thursday, same time. Not same time. Sorry. We start at 5. Okay. Okay, Domini. Thank you so much. Good night. Good night, everyone. Good night. Thank you. Thank you, Ashfa. Thank you. Good night. Good night, guys. I'll see you next week. Study, study, study.